स्लाइड को आगे करनी थी. डू आई हैव द कंट्रोल टू मूव द स्लाइड्स या फिर नेहा आप कर लोगे?
Hi everyone, I welcome you all to our today's session. So the topic of our today's session is valuation requirements of valuation under Income Tax Act. So I quickly tell you about the brief of this topic. So to run a business, every company must have to comply with the Companies Act, Income Tax Act, and sometimes FEMA regulations. Or if it is a listed company, then it must have to follow the SEBI guidelines. Every act, regulations, and its requirements mandate valuation. So, to value a company, what is the valuation method? That is totally a valuer's judgment. But some acts provide the prescribed methods for valuation, where there the valuer is also not having any choice. They have to follow the prescribed method under the various acts. So now in today's session, we'll discuss about what are the requirements of valuation and what are the methodologies prescribed under the Income Tax Act. For this, we are having our expert Mayank Nikhar with us to tell us about in detail about this topic. So he is a advisory transaction service in a head. He's a head of transaction service in Coherent, and he deals in business valuation assignments. He also assists in arbitrations and mergers and acquisitions. He also has his expertise in hand-holding the startups with different stages of fundraising. So, without taking much of your time, I quickly welcome Mayank to start this session.
Yeah, thank you, Neha. Thank you for inviting me, and it's always a pleasure connecting to the audience through Coherent Advisors. And I hope today's session will be enjoyable and knowledgeable, and it will be a learning for all of us involved. So, um, should we upload the slides and start?
Yes, Mayank, you can upload your slides.
Oh, great. So, hope my screen is visible to everyone.
Yes, it is visible.
Great. So, to begin with, I have listed down the contents that this slide covers. However, this is a complete presentation on all the valuation requirements, almost all the valuation requirements that a company faces in its life cycle. But due to constraint in time, I would only be covering uh, I'll be covering only a few of them. So I'll be covering acquisition, merger, demerger, and I will take conversion and others for probably next session. So to begin with, I am taking you the first slide. This is the content. Secondly, why do we need restructuring? So restructuring could be for it is always good for Indian economy. When there is churn, there is buy and sell of companies. It is always good for Indian economy. It is a push for the financial institutions. So you will always find companies being restructured, being amalgamated, merged, demerged. So until unless there is a complete breakdown, this restructuring shall continue happening. So now we come to the motives. Why do companies restructure? There could be financial reasons, there could be strategic reasons, and there could be other reasons such as success planning, diversification. For strategic reasons, of course, growth could be one of the motives. There could be and there could be a value unlocking option that the companies might figure out, and that is why they must have gone for restructuring. For financial reasons, it could be for fundraising, for utilizing excess cash that it has already in its balance sheet, and other matters that I've listed here. So again, as I told you, we will be covering acquisition, merger, and demerger in this session. Under acquisition, I'll be specifically covering share purchase, slump sale, demerged sales. Under merger, there are two kind of merger: normal and fast track. Demerger through NCLT and public sector undertaking. I'll leave these two for probably other session, and hopefully it will hopefully soon. So, getting started with our session. When there's a share purchase, there are two parties involved: one, the buyer, and a seller. So, I'll be taking buyers and sellers' point of view separately. If we look at the sellers, look at it from the seller's point of view, there are two sections which mandate valuation. Now, the conditions that when these two sections will get attracted are: if it is a company which is not a public company, which is issuing company, and the buyer is a resident buyer. If if these two conditions are satisfied, section 56 to 7b states that the consideration, if the consideration is more than the fair value of shares, excess consideration over market value of shares, whatever the delta is, shall become income from other source for the seller or for the company. Now, how do we calculate this fair market value? Fair market value under this section shall be the higher of value as per Rule 11 UA2, or whatever value that the AO is satisfied with. As Neha, I mentioned in the introduction, that selection of a methodology, a valuation methodology, is a valuer's judgment. But in situations when there are regulations or when there are methods prescribed under acts, a valuer must, and he has no other choice but to follow the regulation steps that has been prescribed therein. So, 56 to 7b suggests that the fair market value shall be as per Rule 11 UA. Now, I'm not going into Rule 11 UA2 because it is very basic. You add the assets, you subtract the liabilities, and then arrive at the value. But however, this is a very interesting condition that it has to be higher of value as per Rule 11 UA2, and the value substantiated by company to AO's satisfaction. Now, for 11 UA2, there are two options. One, NAV, as I told you. Another is DCF, that merchant bankers can perform. But when you look at this second option, value substantiated by company to AO, this could be a combination of values. It could be a DCF through a DCF method alone, or could be NAV method alone, or through a combination of DCF, NAV, and multiple method. But the uh, only key thing to notice here is it has to be to AO's satisfaction. If it is to AO's satisfaction, we can use that value as fair market value. Now, coming to the other part, there is one section 50CA that is related to capital gain. Now, what that section says is if the consideration is less than fair market value of shares, as per the value under section 48, it shall be deemed as the consideration. Now, how do we calculate that fair market value? Again, income tax had provided for Rule 11 USC, which the valuer has to follow and work out the value, fair market value. Moving on to the buyer's point of view. The buyer has to look at section 56 to 10 to figure out whether anything will be charged under income from other sources. Now, this is also a very interesting section as far as valuation goes. So, what it states that shares, you have received shares have been received, and no consideration has been paid. But the fair market value of the shares which has been received or which have been received is more than 50,000. Then the FME, the whatever the fair market value shall be the income from other source for buyers. Or if you have received, if shares have been received and you have paid a consideration, but obviously there is a mismatch in the consideration and fair market value, and that mismatch is more than 50,000 to the extent that the consideration is less than the fair market value to an extent of 50,000, then whatever the difference is shall be income from other sources. So what this section tells us is this is the value, fair market value suggested under section 56.210 is the base value over and above the consideration has to be issued. So it cannot go below that, it can always go above that. Again, so fair market value under this section shall be as per Rule 11 UA1. So earlier we had Rule 11 UA2, under this section we have Rule 11 UA1. Both are almost same, it's just that under one section it is A plus B plus C plus D minus L, and for other section is A minus B assets minus liability divided by value per share. So it is very these rules are very easy. They are, you can find these rules on internet. If you go to the Income Tax Act, and you can find these rules. So I'll quickly move on to the next slide. We come to the slump sale. There have been amendments under slump sale, and it has become very interesting now from the point of view of capital gain. So first, what is slump sale? Now, earlier it was slump sale means transfer of more transfer of one or more undertaking as a result of sale, which has been taken out. Now it is only transfer of one or more undertaking by any means for a lump sum consideration without values being assigned to individual assets and liabilities in such sale. Under slump sale, because there is an asset which is being transferred, asset being undertaking, there shall be capital gain which has to be calculated, and tax on capital gain has to be paid. Now, how do we calculate capital gain? Very simple. Whatever we receive as consideration less whatever the cost of that asset was, cost of acquisition that is. But for slump sale, the consideration shall be the fair market value of capital asset as on date of transfer, which has to be calculated specified under a specified rule 11 UAE. It cannot be done in any other way. It has to be done as per rule 11 UAE. Cost of acquisition, the rule says, the act says it has to be the net worth of the undertaking. Now, what is net worth? It is aggregate value of all assets minus liabilities of such liabilities of the undertaking. So, all assets of undertaking less liabilities of such undertaking. First, we will capture the cost of acquisition because FMV of capital asset for consideration is a little lengthy. So, let's take cost of acquisition first. So, for cost of acquisition, the rule says if it is a depreciable asset, the WDV of block of assets shall be considered for the this thing. Aggregate value of all assets. So for under those assets, if we have a depreciable asset, you'll have to take the WDV of block of assets. Sorry. Okay. For goodwill, until unless the goodwill is bought from a previous owner, it has to be considered at nil value. There could be assets which are allowed under section 3580 100% deduction. In those for those assets, the value has to be nil. For any other asset, the value has to be the book value. Right? Now, for capital gain, there is a concept of indexation if it is a long-term capital gain. The assets were held for more than 36 months. Obviously, the period has been revised for some other. I mean, there have been classes of assets which have different period, but for undertaking slump sale, it is still 36 months. So, if the assets were, if the undertaking was more than 36 months old, ideally indexation should have been provided, but for slump sale, benefit of indexation is not available. Also, if the assets were revalued, it has to be ignored. Right? For now coming to the depreciation, if assets, such assets or the future depreciation for the assets shall be calculated by seller who is selling the undertaking after reducing the tax WDV of the assets that has been transferred. Now 54 EC and 54F is available. So I will quickly run you through these because I'm trying to specifically cover the valuation requirements under these sections. So 54 EC is any SEC that invests in either two kind of shares, REC and NHAI. So the period is 6 months from the date of transfer. 54F is for individual or HUF. They have to invest in a residential house. The period is 1 year, either 1 year before or 2 year after the date of transfer if they purchase the residential land, or 3 year after the date of transfer if they construct the land. We will also have to take care of section 281, that is prior permission of no objection certificate has to be taken, and it is called section 281 certificate. So this is the interesting part of I'm sorry, click somewhere else. Okay. So this is the interesting part of slump sale consideration FMV. Now what the act says that the fair market value for uh, the sale consideration for slump sale shall be higher of two fair market value calculations. That is called as FMV1 and FMV2. First we'll take FMV2 and then we'll come back to FMV1. So FMV2 shall be used is when the consideration is received or consideration is occurring as a result of transfer. Now, how do we calculate FMV2? The formula is given above, EFGH. You add these four, you'll get the FMV2. So what is EFGH? E is whatever money that you have received as a consideration or that is accruing as a result of consideration, as a result of transfer. F is fair market value of non-monetary consideration received or accruing as a result of transfer represented by property determined in manner provided under sub-rule 1 of Rule 11 UA for the property covered in that sub-rule. So Rule 11 UA also has list of properties which can be valued for under this rule. So if you are given monetary consideration as well as those properties, the fair value of those properties has to be taken and it has to be worked out as per that rule. Now, there could be uh, some non-monetary consideration which could be in form of a property other than immovable property which has not been referred in that rule. So, those properties which are not immovable properties will have to be taken at fair market value, that is the value that it would have fetched in open market on the basis of valuation report from registered value. Right. So you see when with the properties covered under Rule 11 UA, it has to be worked out as per the valuation has to be done as per Rule 11 UA. If it is not, it has to be done through a registered valuer from and the value that is appearing in the valuation report has to be taken at the value for G. H is the value adopted or assessed or assembled by any authority of the government for the purpose of payment of stamp duty. So whatever value that is determined for paying stamp duty in respect of immovable property. So this is only for the immovable property. So stamp duty valuation has to be done and that has to be added to EFG to arrive at fair market value 2 FMV2. Now, there could be a situation when no fair market value or no consideration is received. In such situations, FMB1 would come in handy. This is similar to Rule 11 UA. This simply states that A, which is book value of all assets other than jewelry, artistic work, share securities, and immovable property, reduced by income tax paid, less amount of income tax refund claimed, if any, and amount shown as assets including unamortized amount of deferred expenditure which do not represent the value of asset. So I'll simply explain what point one suggests here. It says that the balance sheet has suppose advance tax and also has refund. So the income tax is of the view that whatever amount which is excluding refund is income tax. It is just a way of representing in balance sheet that we have represented. But whatever the net amount is, it was supposed to go to the income tax. So that has to be excluded. B is the price which jewelry and artistic work would fetch if sold in open market based on valuation report through a registered value. Again, you have to do a separate valuation for jewelry and artistic works. If you have shares and securities as investments, it has to be done as per Rule 11 UA. Rule 11 UA is similar to FME1. D. This says for immovable property, similar to the point H, it says that the value adopted by any authority of the government for purpose of payment of stamp duty in respect of immovable property. So stamp duty valuation for immovable properties have to be carried out to arrive at the value for D. L is the book value of all liabilities. So A, B, C, D were assets. L is the liability. So reduce the liability from assets, you'll get the sale consideration one. And these are some of the conditions that equity shares shall not form part of liability, reserves and surplus shall not form part of liability. There's an interesting point that if there is a dividend on preference shares and equity which were not declared before the date of transfer at the date of general body meeting. So had it been declared before the date of general meeting, it would be considered as a liability. So this is the FME1, this is the FME2. Higher of it shall be taken as the sale consideration. We have already seen how to arrive at the cost of acquisition. The difference would be capital gain. Depending on the period for which the undertaking has been in operation, what is to be seen is the period of the undertaking, not the individual assets that fall under that undertaking. That will decide whether the capital gain shall be long term or short term, and accordingly, appropriate tax rate shall be applicable on the capital gain. So I have also worked out some case studies around slum sale. This will help us understand the previous slides that we had discussed. So you take an example of a company which will make slum sale, which will sell its undertaking under slum sale. So this is the selling company. This was the balance sheet before slum sale. The balance sheet totals 500 crores, 50 reserves and surplus 150, 300 loans, fixed assets 100, net current assets 40, 400. Now, inside this company, there is an undertaking which has fixed assets of 10 crores, net current assets of 150 crores out of 400 crores, fixed assets 10 crores, so 90 is on account of other undertaking, or it is not part of that undertaking. Undertaking shall have only 10 crores of fixed assets. From 300 loan of the company, the loan that is attributable to the undertaking is only 100 crores. So the net worth simply is 60 crores. Now, we are given that the period of holding or the period for which the undertaking is being operated is more than 36 months. So, whatever capital gain that would arise would be long term capital gain. So, again, I have just mentioned that this is a pointer that FMB 1 and 2, whatever is higher, shall be the sale consideration. Here we have assumed that the 500 crore is the higher of FMB 1 and 2. So what will happen? 500 will be received. Cost of acquisition, we had worked out 60. No indexation shall be allowed. So long-term capital gain comes to 440. And there's a effective tax rate for long-term capital gain. And 103 shall be the long-term capital gain tax that needs to be paid. So how will the balance sheet look after slum sale? So share capital remains intact. Reserves and surplus, as you see, was worth 150 crores. So 500 crores less cost, 440 was the gain. You will have to pay taxes out of that. So this is 337, 440 less 103, profit on sale of undertaking. Loan, earlier it was 300, 100 went with the undertaking, so net 200. Fixed assets, it was 100, 10 was on account of undertaking, which is now sold, so net assets 90. Again, similarly for net current assets, 400 was before slump sale. We were we saw that 150 was on account of undertaking, in the undertaking which has been sold now. So the balance, one second. So the balance 250. Now bank account 500, you received 500 and you paid 103 taxes. So 397 bank is what you are left with after the slump sale. In the books of acquiring company, uh, I hope my video is not, uh, because I think the last line is being hidden from the video. Anyway, let's continue. So this was the balance sheet before acquiring the undertaking, which has been sold under slump sale. So this was the balance sheet. The balance sheet total 700, and what we paid was 500 crores. We got 10 crores of fixed assets, and we got 150 net current assets, and we also took over loan of 100. So this is what it was here: 10, 150, and 100. Now, what we have paid 500. So the long-term capital gain that you were seeing over here for 40, assuming everything in the books is equal to the fair market value, we have paid 440 extra. Now, why will any company pay extra? So it is either for some intangibles, or if not identified intangibles, it is for goodwill. So suppose it did a PPA exercise, and PPA is purchase price allocation. Under purchase price allocation, you identify the intangible assets that are appearing in balance sheet, as well as those are not appearing in balance sheet based on discussions with the management, based on analysis of the company, contracts, etc. Suppose you were able to find out there is an intangible called patent copyrights, and you work out the valuation. You do a intangible asset valuation, and you arrive at a 300 crore value. So for in 500, you paid for fixed assets of 10 crores. You paid for intangible assets, patents and copyrights for 300 crores. You paid for non net current asset for, as you paid for non-current asset 150 crores, and you have taken over a liability of 100 crores. So the remaining that you paid 140 extra, because you cannot attribute a value, an intangible asset to it. So this extra shall be goodwill. Now coming to the balance sheet, how it would appear after the buyer has taken over the undertaking. It would be share capital, reserves, fixed assets were 50, then you add, so it gets to 60. Intangible assets that were recognized, 300. Goodwill, the balancing amount, 140. Net current assets, earlier it was 100, so now you add 150. Bank, because you paid 500, so the balance is 50. 500 was the sale consideration that you had paid, so the remaining bank account now is 50 crores. This is the journal entry that would have been passed. We come to the next case study. So suppose this is a balance sheet, 400 crore company, 400 crore asset size company. This is land, equipment. So what is to be noticed here? So there's only one immovable property, land. This equipment is plant and machinery at original cost of, excuse me, 150 less depreciation. This is accumulated depreciation as per Companies Act. This is other asset 200. Now, what are the other informations that we have? So, fair value of land for the purpose of stamp duty payment is 120 crores. This land, if you do the stamp duty valuation, will the value shall come to 120 crores. Just give me a moment. So now the purchase consideration that has been received is 165 crores were paid in cash. Sorry, the total purchase consideration is 165 crores, out of which 100 crore was paid in cash. There was a plot of INR 50 crores, and there was securities worth 15 crores. This is the breakup of 165 crores. Now, other information that we have is that the fair market value of securities that were transferred. So the security, probably you could not see over here, it is securities worth 15 crores. So this is the another slide that I was opening in my other system. So it is six securities worth 15 crores. That security has a fair market value of 20 crores. The plot that has been transferred here, which is of 50 crores, has a stamp duty valuation of 60 crores. Now depreciation as per income tax is 60 crore. This is also accumulated depreciation throughout the year. So what will be the fair market value? It is higher of FME 1 and 2. So A, B, C, D, and L. So A was, I'll take you back to what A was. A was book value of all assets other than shares, securities, and immovable properties. So what is there? Right. So 200. Hello. Yeah. Is my screen visible? Hello.
Yeah, it's visible.
Okay. 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 All right. All right. So 200 crores. You leave out the shares and there is no share. There is no investment in the company. There is just one immovable property here. So 200 plus 100 equipment plus 120. What was there is NA, so there were no B, no C, only D. So D is land, which was 100. Now the fair value as per stamp duty was 120. L was liability. Liability, we have only one liability, 250 crores. So this is L. This amount represents L. So the net FMV1, the FMV1, if we calculate this, comes to 170 crores. We have to also calculate FMV2 because consideration was received. So E plus F plus G plus H. E is the amount that was received in cash, this 100 crores. F would be I'll take you to what FGH was again so that it is easier for us to comprehend. Right. So F is the non-monetary consideration for properties mentioned under Rule 11 UA. Shares have been represented as property under Rule 11 UA, and what we have also been, so E F we see G is property which is not mentioned under Rule 11 UA. H is the property which is immovable property. So there were two assets that were also transferred in addition to cash, which were plot of 50 crores and securities worth 15 lakh crores. We see that the plot which was transferred for 50 crores has a stamp duty valuation of 60 crores. So this is the 60. We have also seen that securities were transferred, and the security that those securities, if valued under Rule 11 UA, came out to 20 crore. So 100 plus securities plus plot. This is the total value as per FMV2. The sale consideration has to be higher of FMV 1 and 2. So it has to be 180 versus 170, 180 crores will be the consideration for slump sale. Now we'll have to this we arrived at the sale consideration. We also have to take cost of acquisition to complete the capital gain calculation. So the cost of acquisition shall be aggregate value of all assets undertaking less aggregate value of all liabilities undertaken. So only for only those assets which are depreciable assets, WDV has to be taken. So this was 150 was the original cost. This 50 was the Companies Act depreciation, which has to be ignored, and the depreciation as per income tax, which was 60 crores, has to be taken into account. So this becomes 90 plus 100, book value of land 100, WDV of equipment 90, plus book value of all assets 200. So 390. Aggregate value of all liability, we just have one liability 250. So net worth shall be 140 crores. So now we have both the information that we need for capital gain calculation. 180 crores shall be consideration and 140 crores shall be the cost of acquisition. So you can work out the capital gain. Okay. So now that was some say what the capital gain, that is the calculation of capital gain that the seller has to pay. What will happen to the buyer now? Now the buyer has an option of stepping up the cost base, which means the lump sum consideration which he had received, which has been paid for an undertaking, now can be allocated to individual assets and liabilities based on the fair value that will be worked out, where fair values of of all the assets and all the liabilities that has to be compared with the consideration that he has received, and any surplus or deficit shall be goodwill or capital reserve. Now, in absence of book value of individual assets, buyer shall carry out fair value of assets, and depreciation is generally booked on value ascribed. Thereby, Section 32 shall apply to the buyer. So, if there is no value which has been there is no value of individual asset, the buyer has to work out the fair valuation, and that is the value that has to be recorded. So one point, undertaking, if we had incurred losses, that cannot be carried forward because there is a restriction on. Like there is a condition that the owners, there has to be 51% of ownership intact to be able to carry forward the losses. So there's a pictorial representation of what will happen if the purchase price is more than what the fair values of asset less liabilities. So you have obviously paid more than the fair value, so the balancing amount shall be goodwill. It is important to note here that fair assets value less liabilities plus intangible assets that has been later identified and separately valued. So if the purchase price is even higher than the sum total of assets less liabilities that were appearing in the balance sheet, plus the intangible assets that has been recorded over and above the assets which are appearing in the balance sheet, it shall be goodwill. Take a reverse situation. If the purchase price is less than the value of asset less liabilities plus the identified intangibles, so you have paid less, you are at a you are at an advantage here. So capital reserve shall be recorded in the balance sheet of the liability side. These are some of the issues which I could find under an undertaking. Whether all the assets have to be taken or not, the answer is yes. So undertaking is is the smallest unit which is capable of continuing a business operation. So if any of the asset which is taken out, the undertaking will not be able to operate independently, and then the definition, it will not come under the definition of undertaking. So if there is a negative net worth, what do we do? There have been court rulings, Jory Industries Limited versus Mumbai IT80, Sumit Industries Limited. These are the two court rulings. Ideally, if there is a negative net worth, that should be used as per the calculation prescribed under rules, because you have no other choice than to follow the regulations. What will the year of taxability? It is normally when the BTA, business transfer agreement, is executed, or if there is a condition attached to BTA. Only when the condition is fulfilled, then then this taxability arises. Whether the expenditures that have been incurred on this slump sale exercise is allowable or not. So there's no specific prohibition under the Tax Act, Income Tax Act, which restricts the expenditures to be allowed. Again, whether 56.210 be applicable? No, because Section 56.210, as per the definition, the property definition, it does not cover undertaking. I've also tried to cover some of the GST aspects, whether it is slum sale is a supply or not. It is a supply, whether supply of good or service, it is included in supply of services. GST rate and ITC, it is a nil rated notification. There is a notification which says that it has been nil rated, so there's no question of ITC. Under GST, you will also have to value slum sale. That is the transaction value under Rule 31 states that the residual method for determining of value of supply of goods or services of both. Transaction value shall be the net consideration agreed between the parties. Now, this net consideration shall again be dependent on the valuation exercise that would be separate, that would have been undertaken by the buyers and sellers independently, and they would have agreed to a mutual price. Now we have seen slum sale. We'll come to the itemized sale. I believe I'm running short of time, but I'll quickly try to go through the slides. So itemized sale is when you don't take the undertaking as a whole, but you pick and choose, cherry pick the assets out of the balance sheet. These that are called itemized sale. It is simply uh, the assets being sold out of block of assets. It will always be a short-term capital gain, and fair value of consideration shall be computed under section 50C, and fair value of consideration. Uh, and if it is a case of land and building, you have to follow the 50C section. If it is unquoted shares, you have to follow section 50CA. 50C is fair market value plus 5% bandwidth that the tax has suggested, Income Tax Act has suggested. For buyer, there is an explanation to section 43B, which says the value shall be the value which shall be determined, which has been determined by the AO, shall be deemed to be the actual cost to the buyer. If buyer is not satisfied and he is of the view that the transfer or this transaction was for reduction of liability to income tax. Merger and acquisition. There were two companies, A Limited, B Limited, that it had separate shareholders. Now what happened? These two companies merged together to form A and B Limited, and both the shareholders become shareholders of A and B Limited. So it is merger of one or more companies with another company, and it is two or more companies forming another company. The conditions are that the merger, this transaction has to be structured in such a way that all the properties of the transferor company becomes the properties of the transferor. Transferring, actually, it is all the share. Is a typo here. So all the properties of A and B become the properties of AB Limited. All the liabilities of A and B become the liability of AB Limited. Shareholding not less than three-fourth in value of the shares. So the shareholders which were there in A Limited and B Limited, you'll have to work out value of A Limited and B Limited and three-fourth of that value. So the shareholders which are holding such amount of shares which is either equal to or more than three-fourth of the total value of the company must become shareholders of AB Limited for merger to be compliant with the prescribed to comply with the prescribed method under which an amalgamation will be recognized as how do you call it effective. So now there's a question: what if shares instead of shares, cash and debentures are issued? So if cash and debentures are issued, they will not become shareholders. So this condition shall not be satisfied, and it will fail to fall under the definition of merger. What for transferred company in hands of transferred company? So such transaction has been excluded as transfer, and it will not be taxed as capital gain. For the shareholders of the transferor company, again, it has been taken out from the definition of transfer via section 47, subsection 7. The cost of acquisition and the period of holding shall be the cost of acquisition of the previous company, and the period of holding shall also include the cost period that the shareholder had held shared in the previous company. So in the hands of for transferee company, what will happen? Cost of acquisition of stock shall be computed as 43C at cost to amalgamating company and improvement cost. Cost of acquisition for depreciable assets shall be as per explanation 43(1) and 43C. Cost of acquisition for capital asset under situation specified under section 41(1), 49(1) shall be the cost of asset to previous owner along with improvement cost. Now again, these are simple points. I'm trying to skip those points because there's no valuation requirement under these sections. So simply period of holding, what should be the period of holding, what will be the carry forward loss and business losses. So carry forward will be of losses shall be for fresh 7 years, unabsorbed depreciation for unlimited period. Uh, I don't think anything here relates to valuation. It is simply carry forward of losses. Which companies can go for carry forward of losses in case of amalgamation? Uh, Technically, also owning industrial undertaking or a ship or hotel with another company, a banking company, public sector companies with one more public sector companies, other conditions. Three-fourths of the book value of the fixed assets of amalgamating company held for at least 5 years after amalgamation continues the business of amalgamating company for 5 years. So these are some of the conditions which are required for amalgamation. So again, I'll quickly move through this. Applicability of section 79. There's a restriction for carry forward of losses unabsorbed depreciation. This is for 8 years. This is for there's no restriction on unabsorbed depreciation. That will be taken. Again, I'll quickly move through the slides. For demerger, what happens? There is a company A Limited which has two divisions, and the company decides that one of the divisions it will not work. I mean, it will only be working with one division, and decides to demerge, hive off another division. So this division two is transferred to a new company B Limited, and B Limited shall issue shares to the shareholders of A Limited. B Limited might already have shareholders. So this structure is called demerger. Now what happens is demerger. I'll quickly just try to read through the slides. So all properties of the undertaking. So this division one, all assets and liabilities become the assets and liabilities of B Limited. All properties and liabilities are transferred at book values. So whatever the assets and liabilities that were recorded here will be transferred at book values, except when when there is an Ind-AS requirement which states that the transfer has to be a fair value. So fair value again has to be worked out, and the fair value has to be recorded as the value of assets and liabilities. There's a condition of three-fourth in value of shares. Again, over here, uh, this I think there are these are just two. There are two just instances of valuation requirement under this section. I've also tried to just simply put down the tax implications. So what will happen for demerged company? It is not a transfer. Proportionate depreciation shall be allowed. Resulting company proportionate depreciation. Depreciable assets. Closing of the demerged company shall be the opening of resulting company. Obviously, capital assets. The cost of the previous owners shall be considered. Period of holding. Obviously, previous owners shall be considered. 56(2), there is no, it does not fall under property. Cost of acquisition of shares on demerger by the shareholders. Now, this is an important point. So, cost of acquisition of shares which shall be received on demerger by the shareholders. How do we find that? So, it is the formula has been prescribed. We'll have to follow the formula. So, cost of acquisition of shares in demerged company multiplied by net book value of assets transferred divided by net worth of demerged company immediately before demerger. So this ratio into the cost of acquisition of shares becomes my cost of acquisition. Period of holding again shall be included. Period of holding of demerged company shall be included in the period of holding of the by the shareholders for the if, for period of holding of shares received on demerger by the shareholder. So whatever shares that the shareholders existing shareholders have received for demerger, the period of holding shall include the period of holding of original company as well. Whether deemed dividend for shareholders not allowed. So section 222(5) has specifically ruled out that it will be a deemed dividend. Carry forward again, no specific condition to be made. Loss directly relatable to demerged undertaking is transferred to resulting company. So whatever loss that specified that was specifically due on account of the undertaking shall only be transferred to the resulting company. And if that loss is not directly relatable, it has to be proportionate in ratio of assets retained by demerged company and the assets transferred. So the ratio has to be worked out, and then the loss has to be apportioned, and the related loss which was attributable to the assets of the demerged company has to be transferred. This is the glossary. I believe we have already shooted ahead of the scheduled time. So thank you, everyone who has joined in, and you can reach out to me for any of the queries, or you can mail to us. We'll try and get back to each of the queries that you have. I'll also share this slide so that in case someone has any queries around it, can come back to us with their queries and we'll reply to them. Just because we had started a little late, and I believe we had to rush to the end of the slides. Thank you.
Thank you, Mayank, for this wonderful session. And I think you have explained everything in very much detail about valuation requirements. So I hope we'll be coming with you another sessions for topics on mergers and demergers very soon. So thank you for giving your time for this session today. Thank you, everyone.
Thank you, Neha. Thank you, everyone. It was a pleasure.